Welcome to Positive Business Action, the podcast where we explore real strategies, real stories, and real solutions to help you grow a stronger, more profitable business. Each episode, we break down practical ideas that you can actually use, from marketing and guest experience to operations, team culture, and long-term growth. Whether you run a farm, manage an attraction, or just love the business side of making memories for guests, you're in the right place. Let's jump right in.
Hey gang, welcome to Positive Business Action podcast. And today, you don't have to just listen to Hugh chit-chat about his own stuff. You don't have to worry about John looking fabulous on camera, because today we've got a guest in with us and we're talking about some stuff that I find incredibly boring and incredibly valuable. Isn't it always that way? Like the thing that's the least sexy can be the big profit maker, keeper, I guess, in this case, right, Chris? We're talking about keeping your profits. And so today I've got Chris Roehm with me from C-Singe, and he's about as nerdy a financial guy as you could find and has a real specialty that we're going to talk about. But before we get started today, we do need to have a little disclaimer. Hugh doesn't know anything about financial stuff. Man, am I good at attractions and marketing and stuff like that. Talking, really good at talking, but I don't have any financial certifications. So I am not offering any financial advice to you. And so please just treat this as entertainment value. I am going to be sharing kind of some stuff that we did. That's just my personal experience. I'm not recommending that you do any of that because we have an actual professional along with us. So Chris, give us your professional credentials, and I'm sure you've got a disclaimer in there too, just to keep everybody safe out on the interwebs.
Well, first of all, I think this stuff is really sexy and interesting and fun, but that's what makes you and me different. That's what makes the world go round. So I am Chris Roehm. I'm a certified financial planner. I'm a registered rep with Integrity Wealth, and I'm an investment advisor representative with Senge Advisors. So that's my disclaimer, and that I don't give legal or tax advice. So as a CFP, I am allowed to and accepted by the industry to educate people about taxes and about trust provisions and legal provisions and planning provisions. But of course, you would always consult your tax or legal advisor before you did anything.
Right on, right on. But so yes, I will say, being profitable is sexy, right? That's the fun part. Being profitable is sexy, and keeping your profits and reducing your tax burden is also pretty darn important. And that's really where our two lines crossed in what I think we would both later realize was the nick of time. The nick of time. For me, I came across...
It's happened quite a bit in the last 4 years since I've been specializing. I call it 911. What's your emergency? I get these calls, my taxes are due tomorrow and I owe, $40,000. What am I going to do?
That's right. That's right. And for me, it was a financial aid potential looming disaster, right? We go and we try to be very successful. And of course, we want our kids to have, all of these great opportunities. And there's this immense ocean of financial aid out there. But of course, what they want to do is disqualify everybody as quickly as possible so that you can just pay full rate going to college. And that's kind of where you came in for me, happenstance, looking over my dad's shoulder while he was on another webinar. And he said, "Hey, Hugh, come listen to this guy." And he's not talking about grain trading, which, generally puts me to sleep. And so from that webinar, then we had a call. I quickly filed an extension so that I would, we could actually have a chance to talk about the cash balance plans we're going to chat about, so that my kids could continue to qualify for financial aid. And the reason is, it's not because I'm extraordinarily tricky, but farmers, I want you to think about this, right? What happens? Kid goes to college, happens to be applying for financial aid in your good year, right? In the good year. Hey, farmers out there, tell me what's going to happen next year. You don't know, right? Drought, famine, flood, a swarm of locusts. No one knows what's going to happen next year. But now all of a sudden you're on the hook because you applied for financial aid in that one crazy year. And so that's kind of where we came together here on the cash balance plans, and how it kind of helped for us to continue to qualify for financial aid. Now, I will share with you, between my two kids, financial aid was a $385,000 savings. I don't want to bury the lead, right? That's crazy, right? I mean, that's a life-changing amount of debt that could have been piled on me and my kids, or it's a life-changing amount of, future potential that they will not have this millstone around their necks. And that's why I like Chris, even if he thinks financial cash balance plans are the sexiest thing on the planet.
Well, just about not burying the lead, that definitely matched up with your circumstances and helped you quite a bit in qualifying for the funded college aid. But most of my clients are doing it for the tax deduction, just to save on income taxes in the current year. Now, a side benefit or an additional benefit of that is anything in the tax code today, and with the big beautiful bill, there's lots of provisions that are income based and have cliffs and phase out periods based on your income. And that can happen at the state and at the federal level. So college aid, you could think like Medicare, even like Obamacare subsidies. And there's a number of other. The state and local tax deductions are phased out if your income's over a certain level. So if you do a cash balance plan, it lowers your adjusted gross income and gets you back in the sweet spot for all these other tax savings. And there's others that I'm leaving out. But
Right. So
it's
really, and
yeah.
I guess that could be a confusing point. To qualify for financial aid, you need to reduce your taxable income, right? So I
Yep.
happen to be in this one little weird box where reducing my taxable income also had this incredible benefit of qualifying for financial aid. But really, we're talking about, these are real, on the books tax policy, where you can use existing stuff to reduce your taxable income, right? This isn't new stuff we're talking about. This is on the books. Cash balance plan's
Yeah,
been around for years.
most people have heard of ERISA. It was what is it, Employee Retirement Security Income Act. It was like 1974 that laid the foundation for these plans. I get every once in a while, yesterday included, somebody I'm on the phone. Actually, it was your friend that you referred me to down in Virginia. And he's like, where can I go to learn more about these? I'm like, well, it's irs.gov.
Yeah,
Yeah.
that's right. So this is all existing stuff, but I had never heard about it. My accountant had never heard about it or mentioned it or whatever. Why doesn't everybody know about this stuff?
Yeah, that's a big question. I've worked for a number of years to come up with a good reason. And I've always said, don't throw the CPA under the bus, like, because they should know about this. But I think the real answer is that it doesn't apply to everyone. It has become much more popular in the last 15 years because with passage of certain tax reform, starting with, and I know this is unsexy, but the Pension Protection Act of 2000, and then with the Secure Act version 1 and 2, and with the Trump tax reforms from his first term and the current, have all made this a lot better and more favorable for employers. That would include, of course, farmers and agritourism. Just the rules have come a lot more favorable to benefit the owners and to benefit their personal tax situations. And so um, it's just become more popular. You can see in the slides that I presented there in front of you, you have it what I presented at NAFTMA. It's really gone up since 2001, and there's about 67,000 cash balance plans in America today. What's the number that the conference I was at yesterday quoted as their best guess as to how many of these plans are in existence today in the United States.
Yeah, so we're not talking about anything new. To me, the crazy part though was that in the end, the big idea that average guy Hugh can get his head around is, this plan can be structured for me, does need to include the employees, but those percentages can move around a little bit. And the contributions just come off as an expense in my P&L. That was the part that non-CPA Hugh could get a hold of. Like, just kind of go through how that like you would have
Yeah.
explained at NAFTA, and you've been at NAFTA now 2 years. So, this isn't even new now to agritourism. It just happens to apply to us.
So maybe just a 30-second story of how these plans originated. It was like the big unions and giant companies that in the old days, back in the 90s, were providing pension benefits for their executives. Well, the ERISA Act that I mentioned a minute ago, that sort of codified it because they were doing it even before ERISA. And the IRS and the Congress said, okay, we should put some rules in place for this. So they established these retirement plans that a company can sponsor. So an individual can't do this, but if you own a business, if you're a sole proprietor, S corp, LLC, anything, you sponsor a retirement plan for yourself and your employees. And when you fund that, it's a tax deduction because it's an ordinary necessary business expense. And the difference between a cash balance plan and like what everybody is familiar with, the 401k plan, is that K plan and SEPs and simples and some of the other flavors, they're all limited to the amount you can contribute each year. And a cash balance plan is not limited to how much you can contribute in any given year. It's a lifetime contribution limit. So if you think about the pension plan, if you're an executive and you're going to retire, you're going to get a guaranteed pension plan, so much a month, so much a year from the day you retire until the day you die. That's how these pensions work. Well, you can set one up for yourself.
The classic down at the steel mill, down at the steel mill.
Exactly. Um, I lived in New Kensington, Pennsylvania for one summer, and then I lived in Lorain, Ohio one summer. And I was selling dictionaries and Bibles door to door to pay my way through college. And these were people working at the Ford plant in Lorain, Ohio. And they didn't get their pension, all of them, but that's another story. But yeah, that's another story. But the idea is that you can set this up for yourself, and this is why you're allowed to make large contributions, because you have to have this pension fully funded before you reach retirement age. And we can set the retirement age at whatever you want, because this is a custom plan just for you. And if you only have 5 years until you reach retirement age, and you need $1 million in your pension plan to provide this future benefit, you can put $100,000 or $200,000 or $300,000 in each year and deduct that from your income. That took a little longer than 30 seconds, but that's the concept right there.
Yeah, thanks for explaining so that I could understand it the first time round. But yeah, and what I think farmers do plug into, and certainly what I plug into, is nobody's coming to save me. Nobody's coming. I don't think, I mean, I'm Gen X and I don't think I'm getting any Social Security. You got to be kidding me. They're going to be out of money before I even get into my 60s, right? I mean, no one's coming to, you better figure this out yourself. And I think so many farms are thinking, well, I would either sell the farm or I would find a magical person who's going to come in and lease this agritourism operation from me, and that's going to fund my retirement. Where I would say, no one's coming. You had better want it. I mean,
I have a
kids
slightly
aren't
different
coming.
take on that.
Who knows?
I think Social Security will be there, but it's definitely not going to be enough to support your lifestyle the way that that you're used to. I think but who knows, right? I mean, I certainly don't. When I'm doing financial plans, I typically don't include Social Security because people don't want to count on that. So that's a very valid point. And the second is that a lot of the business owners that I've worked for the last 20 years, they know they can sell their business or they can lease their farm ground and they can squeak by on getting $300 in a month rent on 1,000 acres in Illinois, right? But it's still good to diversify. It's still good to have liquidity. It's still good to have other sources of income. And it's great that the government will help you fund this by allowing you to deduct these contributions from your taxes. And I think that's the fine point that I wanted to make is while these are retirement plans, I would say 80% of my clients, and this is true back to 20 years that I've been doing this, is that 80% of my clients really don't intend or aren't really doing this because they're worried about where they're going to get their income from in retirement. They've got that pretty well figured out, but they're doing it to save taxes, and that's huge.
Man,
Save current
nobody
taxes.
Nobody likes the tax man. That's for sure. That's for
No.
sure. Now, I grew up pretty standard, trying to figure out, what are my parents doing? What, learn the business, all of that kind of stuff. And the classic is you get into December. Oh no, we we had a good year. I'm looking,
Yeah.
oh no, the government's going to come and get the tax, they're going to get a big check. And then we get the
Yeah.
call from the accountant who says, hey, you gotta go out and spend a little money here. Government's going to get a big chunk of this. Right. I mean, that's,
So
that's what we do. Right.
in
That's
the
what,
thousands of conversations, without any exaggeration, I've had with business owners in the last 20 years, that's so common. I call the accountant in November or December, or we have our tax planning meeting, and I'm like, look, I owe all this. This accountant says you're going to owe all this tax, and then that's the solution is, well, I got to go spend some money. Yeah, if I don't spend it, the government's going to get it, right? And um, and
John Deere might as well get it.
of course you need equipment, and of course you need super mega slides to grow your business and to grow you've got legitimate capital outlays to grow your business. But wouldn't it be really nice, in addition to that, if you could, instead of spending money to save taxes, if you could save money and save taxes? And that's exactly what this is, because you get to save money in your own retirement account, and you get to deduct that from your income. So that's the yeah. And it's just one more smart thing that everybody should be doing, right? I'm not saying that you don't need future capital expenses or to put up a barn to have weddings or any of those things. Just budget this, find some cash flow so you can put $100,000 a year in this or more, and have half a million or $1 million, or the limit now is the lifetime limit now is right at around $3.7 million. That you can have $3.7 million of a cash balance plan lump sum in the account on the day that you retire. And that should be everybody's goal.
Yeah. Yeah, I mean, that's just a different way of looking at it. One of the reasons why I liked it, because, hey, we've had some good years, and what did I do? I went out and now we have a 65-foot boom lift, and we have a new orchard tractor, and we have solar on the farm, and we have a giant new barn, and we have, and a bar that we put in
Yeah.
that barn. And after a while, I'm like, you really need anything else. Like, I mean, I guess you could,
Yeah. All
you
those
can keep
things are
buying stuff you
good.
don't
And
need, but it doesn't make business
there's
sense to do
it
that.
shouldn't the tail shouldn't wag the dog, right? There's obviously capital expenditures that are smart business decisions, but um the secret to creating wealth is to concentrate, build your business. But the secret to protecting wealth is to diversify. And it's just one more smart thing that you can do, and it's use it or lose it. If you don't fund this plan while you have earned income, ordinary income, then you can't do it in the future. So yeah, but going back to why not everybody does it, it's not for everyone. You have to be earning good income. You have to be ready, willing, and able to contribute at least $100,000 a year to this plan, deducted from your income. There are other plans you can do if you don't need or want to contribute that much. There are administrative costs, and there are setup fees, and there's a little bit of complexity involved with setting up a cash balance plan. But if you're like, if you are ready, willing, and able to, and want to put $100,000 in a year, deduct that from your income, that's the no-brainer level. It really
Right.
is.
Right.
Yeah.
And like you're saying, it is diversification. And I also, it's funny, you hear people talk about this is the plan or that is the plan, and you have to, and what do they say? Oh, you gotta stop doing everything else. You can have no more capital you gotta go 100% all in on whatever. And what we're really talking about, I mean, for me anyway, is this is just diversification, right? We still buy equipment, we still upgrade the barn, we still fix the stuff. We're still doing that stuff, but this is just a
Yes.
piece of the pie.
It's hedging.
We're not
It's
saying
it's Yeah,
do
it's
everything.
hedging too, because people are saying, "Why would I do this and deduct this from my taxes now when I think taxes are going to be higher in the future?" Well, who knows what taxes are going to be in the future? Elon Musk, I think, published an article yesterday that he thinks all income tax might go away forever, with all the AI and the tariffs and everything else. So who's to say, right? But for most business owners, that especially as they get closer to retirement, as you get closer to transferring some or all the business to your successor, it's probably your highest earning income years that you'll ever have. So by putting it away and being able to deduct as taxes, you very well may be in a lower tax bracket in the future. And I think this is the first time I've put it this way, but I think it makes a lot of sense for the business owner, farmer who has a lot of other investments and says, "I'll never be in a lower tax bracket." I would agree. I agree that you may never be in a lower tax bracket, but you'll also never need your retirement money. So you could leave it in there forever. You could have it compounding tax-free forever. Now you do have to take out the required minimum distributions. And for someone our age, it's not until we're 75. And then it's only about 4% a year. And so, if someone who's, let's say, 60 years old today can defer the tax on a lot of this money for the next 35 years, that's probably life expectancy. And then your kids inherit it, they get 10 years to defer beyond that. So we can defer the tax on this money for a long, long time.
Yeah.
That's the key
And
point
what you're
here.
talking about there, and you can just, maybe you don't need it, right? You can roll it forward. Maybe it is part of the legacy. Maybe it's part of whatever. That's very similar to, the section in my NAFTMA talk this past uh, February. Well, I guess just a couple of weeks ago, really. And that's where what I think you should do is plan for your retirement outside and away from selling the business. I think as business owners, we need to start very particularly preparing for ourselves so that should we be so fortunate that one of our kids wants to come back, we are not saddling them with you have to buy the business, the farm, whatever. You have to buy that for me to provide for me in my retirement, right? Like you said, I feel like I'm in my prime earning years and I need to take care of this for myself. So I'm not putting a millstone around my kids by making them buy or sell the farm. And I know you've worked on a bunch of what would we call that estate planning and that kind of thing.
Well,
So
I
how does
used to,
this like fit in for
yeah.
that?
I used to own a software company. I sold it in 2006, and it wasn't like retire forever type of money, but it was a great transaction. But I got into financial planning because I realized that I didn't know what I was doing when I was positioning my business for a sale. So I wanted to do business succession, tax estate, business succession planning for small business owners, and it's all about options. And so now I don't do that anymore just because this is my entire focus is the cash balance plan. But it's a very important component to the overall succession plan, whether it's a business succession or farm succession, because it gives you options. You've got cash, you've got liquid cash that you can draw on that does not depend on the sale of your farm or business. It doesn't depend on a lot. It doesn't depend on a lot of the types of risks that you and I are exposed to as entrepreneurs. I used to say, and I guess it's still true, we're one phone call away from oblivion. Every entrepreneur in America, every small business owner, one phone call from oblivion. What do I mean by that? Well, we just decided that agritourism is illegal. You can't do that anymore. I mean, that's an extreme case, but you get the idea. And I think that,
It could be, hey, we're going to eminent domain your farm for a data center.
yeah,
I
yeah,
mean, there are people
exactly.
fighting stuff like that right
Yeah,
now, which would be
exactly.
crazy.
Right. So many, you could use your imagination to come up with lots of what, and entrepreneurs know this. So it's tremendously risky what we're doing as entrepreneurs. So this is something really safe and conservative is, put money away for your own retirement and deduct it from your taxes in the meantime.
Yeah.
Yeah.
And so in actually implementing something like this, I know some of my questions were, hey, we're talking about this in a great year. What happens if my income drops? What happens if my wife dies? What happens if I switch CPAs? Like, I mean, what are some of the things that you hear people asking that we can just answer those right now for everybody?
So these are certainly some of the reasons that not everybody has done this or not everybody has heard about it. And a lot of it is the tax advisors, the CPAs, the enrolled agents that that really don't go out of their way to recommend tax. They're not financial advisors, and so one of the
I want to
reasons that
pause right there because I don't want to gloss past that. And it's not in any particular pejorative way,
mm-mm.
but most CPAs are not tax advisors. Now, for me, for years, right, I've been doing this 30 years. For plenty of years, all I needed was a CPA to keep me, right, get it filed. For plenty of years at the beginning, I didn't have to worry about extraordinary income, right? Like a CPA is fine, right? But as you get into that middle, right, where you that middle profitability, and you're moving towards the next level in the business, yes, you need a CPA, but they're not a tax advisor, right? Just
Well,
like
the
you
good
wouldn't.
ones certainly are, right? The good ones certainly are, but you need everything, right? It's three legs of the stool, like in everything you do. You need a butcher, a baker, and a candlestick maker, and you want a good team that's going to advise you and bring you good ideas. And then a lot of financial advisors say they want to be your quarterback. I've never said that. I like the idea of quarterback coach, so I don't mind being you're the quarterback, but I'm the quarterback coach. So I'm up in the press box. I can see the whole field. I understand finance. I understand insurance. I understand investments. I understand taxes. I understand estate planning. And I can radio plays to your helmet as the quarterback. And then you decide if you want to run that play or call that audible. But getting back to the flexibility, because that's a main reason that CPAs say, oh, you don't want to get involved in a cash balance plan. If you have a bad year, you're required to fund this. And it's just not true. And this has changed really over the last 20 years. So 2010, in my presentation at NAFTA, I have a slide in there about one of the laws that changed in 2010 that really made cash balance plans much more attractive for a much more wide diversity in types of businesses. And so then someone would say, well, just send me the rules. Let me read it. Send me one page that tells me how this works. Well, I was at this conference yesterday, all day in Miami, and they they made one comment there that I think will be really enlightening for your listeners. Is that there's 4,000 pages of code and regs that have been published and promulgated about retirement plans since ERISA was enacted in 1974. So you have to have somebody who reads these 4,000 pages of code and regs and understands it and is able to custom design a plan for you. So I have that. I have that on my team. And with proper plan design and with proper management and utilizing the tools that some of these more recent tax changes like the Secure Act have made to amend a plan and to change the minimum required, contributions. All these things go to make these plans much more flexible and much more suitable for a wider range of people. Was that a good answer?
Yeah, I think the what we're talking about here it is complicated, right? And that's why there are cash balance nerds like you, when really all I want to do is run my business and do the next build the next attraction, and
Yeah.
do those kind of things.
Just tell me
I
how
like
much
that
I can
coach.
deduct. That's what people want. Just tell me how much I can deduct. Yeah.
That's right. That's right. So I guess that was all part when we got together. I had to get you some basic amount of, and maybe live here I can get you to commit. Would you be willing to chat with anybody who calls you of our
Yes.
listeners?
Yeah, of
Like
course.
just to see if they should even like take a look at this. Would you
I've
would you
spoken
do
with
that?
thousands of business owners over the years. And like when I was first getting started 4 years ago, I'd talk to anybody. Now I don't need to practice so much anymore. But in a 5-minute conversation, I'll talk to anybody. In the 5-minute conversation, we will both know if this is something that we want to spend more time on and that you want to learn more about. So absolutely, I'm happy to speak with any of your listeners. And here's the other side of that. Well, just send me something, or just send me the one pager, or let me watch a video. It's not like that. It's much better I can send you an hour-long webinar recording that I've done with you. We can tell in 5 minutes if this is going to be something suitable for you or not. So you have access to me, one of the world's experts on this. I've done over 100 plans in the last 4 years. That's more than most people have done and that will ever do in their whole career. And so I know the right questions to ask, and we'll know right away if this is something you want to dig into or not. Yeah.
All right, you committed to it. So I'm gonna have John make sure that in the show notes we've got a link there for you if you want to just schedule just a 5-minute call. I don't think that's too far out, unless
Mm.
right, you're not paying taxes. That just means you're not profitable enough yet, and you can work your way there. That's
Well, that's
totally
my
cool.
question, right? Do you owe a lot of taxes this year? And we can still do this for 2025. Don't forget. That's the 5-minute call. Hugh,
Wait, what's
are
the
you?
give them the timeline? Because what's the um when
So here it
do
is.
people
I'm
need to
looking
know
at
what by when
looking
for
at my
which
calendar
year?
over here. It's the 27th of February today. So most farmers, especially if you're a sole proprietor, will file their taxes by March 1st. And so we don't have enough time to get this done by March 1st. Well, March 2nd is is Monday. But if you can file an extension, or if you don't, if you file as any type of a business entity, it's not due until March 15th, sometimes later. But we can set up a cash balance plan for 2025 up to the day that you file your tax return, your business tax return for last year, including all extensions. And so I don't think there's probably too many people that are planning on filing on Monday that are going to learn about this and say, "Oh my gosh, I got to go file an extension." You certainly can, but most people that are having that need this or have this level of income where they're doing tax, they're never going to file they're going to file an extension every year because they haven't
You
gotten all
mentioned
their K1s and stuff. Yeah.
Today's episode is brought to you by Maize Quest's Maize Catalog, helping farms create unforgettable corn mazes and stronger agritourism businesses. Join the funnest group of farmers in the world at maizecatalog.com. And now back to the show. This episode is sponsored by the Hen House Hustle, and trust me, it's exactly what your guests are looking for. Fun, memorable, and built to keep people coming back. Learn more at thehenhousehustle.com. And now back to the show. This episode is sponsored by the Super Mega Ride and Slide. Guests go down, profits go up. If you're looking to create an unforgettable experience that keeps people coming back and drives serious revenue while you're at it, this might be exactly what your business needs. For more information, go to supermegarideandslide.com. And now back to the show.
Yeah, so you mentioned the entities. So what is the difference? I mean, I've got an S corp, 2 LLCs. The winery had to be different. Blah blah blah. Like, what are the entity? I mean, who can actually do these in terms of like
Yes.
C corp, S corp? What's the?
Yep. So the tax law applies to everyone in America. But these are, don't forget, business sponsored retirement plans. So anybody who owns a business, and it doesn't matter what entity you have or how you file the taxes for that entity, you can be a sole proprietor. If you file a Schedule F as a farmer, or if you file a Schedule C for self-employment income, you can do this. Certainly if you have a business entity, if you have an S corp or a C corp, you can do this. If you're a partnership, you can do it. And if you're an LLC, a lot of people don't know this. How do you file taxes? Well, I have an LLC. Well, there's two options. You can either file as an S corp or as a partnership, and a lot of people, or as a sole proprietor, I guess, in some cases. But and the short answer is anybody can do it. If you own a business, the business sponsors this plan. It's a tax deduction at the business level, and anybody can do it. And there's no minimum and there's no maximum age. But that does get back to suitability. It's not for everyone. You can put $7,000 in an IRA, no matter who you are. You can do somewhere around, depending on your income, you can do 40, 50, 60, $70,000 a year putting in pre-tax with a 401k or a SEP or a profit sharing plan. But if you want to do more than that, you can put in $100,000 or more. There's no retirement plan that is recognized by the IRS as a qualified plan that you can make larger deductible contributions to than a cash balance plan.
Gotcha.
Anybody can do it. The facts and circumstances have to line up too, and this is another reason why it's not for everyone. And this is important. So I have another minute to cover this, Hugh. Should I cover it now?
Yeah,
So,
let's just do it. We're here.
and I'm going to come out with a webinar that I'm going to offer in the coming days or weeks, where it's people that aren't going to do a plan this year for whatever reason, but how to set yourself up to be able to do this when you're ready. And I think this will be a giant game changer because let's take farmers, for example. They're really good at keeping their taxes low because they prepay expenses.
Right.
They defer their sales until January 2nd, and they buy equipment and they write it off as depreciation. They use the accelerated depreciation. So I've got farmers that have have grown very wealthy, have bought a lot of land, have paid off their land, yet they've never paid taxes because they have so much depreciation. They've never really shown any farm profits, and they're not eligible to do a pension plan. They're not eligible to do one of these.
Right.
If you think about it like this, if you work for the union and they're going to give you a pension benefit, they're never going to pay you more in retirement than you earned while you were working. And the same is true now. The way that the government has set the rules up, we can base your pension benefit on your highest 3-year average income. And so if you haven't ever paid much into Social Security, that's another way of thinking about it. Because if you're self-employed or you own a company and you take a salary from your company, you're paying into your Social Security. Whether you think Social Security will be there when you need it or not doesn't matter. But that's earned income, and that's the amount that you pay Social Security and Medicare tax on is what we can use to justify a large pension contribution. So the action to take now is, and maybe this is another 5-minute phone call, is just make sure that you are paying enough tax, showing enough earned income now and over the next 3 years so that you can max out your cash balance plan at whatever. You can define the size of your bucket at whatever you want to be by making sure you take the right amount of average income over the next 3 years.
Yeah,
That's a little
I
more
had
complicated, but
I
we
actually
can.
had a good CPA
That's a
once who
concept.
long ago said, hey, one of the problems with, your S corp is a lot of people just take distributions, and he said that can even
Right.
be an IRS red flag. He said make sure that you're waging
Definitely.
yourself, you're paying your
Correct.
you're paying your Social Security, taxes, you're paying all of that stuff. You can split it with the distribution, the profits at the end, you can split that, but you have to make sure you're paying yourself a wage. Now, in my presentation at NAFMA, I say you have to make sure you're paying yourself a wage, because if you ever went to sell your business or hire a manager, if you haven't planned in your business to have that wage there, then
Right. Your
you
buyer's going
can't
to add that
support it.
in. Right. Your
Right?
buyer is going to pay a manager to do your job. So yeah, exactly right. And that's the way the IRS looks at it too. The wage has to be reasonable. Who in their right mind would do the job you're doing, Hugh, for this wage? And if you say no one would do this job for what I'm paying myself, then you're going to have a hard time justifying, paying that little bit of Social Security tax. But here's the tragedy of the whole thing: people are splitting hairs, or my dad used to say, picking the fly poop out of the pepper. So they're worried about paying the 7.5% self-employment tax or the 15.3% Social Security and Medicare tax, but they're what's the other expression? The forest for the trees. You're precluding yourself from taking a much bigger tax deduction and saving way more on taxes if you had taken a reasonable wage. And I don't know exactly what this number is. I've got a team that's working on a calculator for me with me. And it's probably not the same for everyone because people have other income, people have investment income, interest income, dividend income, capital, you name it. But if your company is making, if your income is somewhere around $200,000, you should be, uh, you're not going to benefit by having a small salary and paying low into Social Security, because of the much larger tax deduction you can take from all of these qualified plans, not just the cash balance plan that I specialize in, but it's true for SEP IRAs, for simples, 401ks, for profit sharing plans too. It's all based on the salary that you take.
Right. So just to kind of recap and simplify, if you were thinking, hey, maybe I'm not where I can take this plan or deploy this plan right now, the way to prepare is to make sure that you are paying yourself a decent enough salary. So when it gets time to calculate for the cash balance plan deduction,
Yes. Yes.
that you have a high enough income. And we're saying whatever you pay yourself in those small wage taxes is mildly irrelevant if at the end of that you can start deducting 100,000 or 200,000 or more from
Yeah.
your P&L, right, at your business. So it's kind of like, if you're not set up right now, you could take a couple of years and be ready to really make a big impact
Yes.
as your business
Exactly right.
grows.
And on one
Got it.
hand, we talked about diversity, and we talked about some of the soft reasons and soft issues for having liquidity outside of all of that. But this is math. So if you want to just do the math on the taxes, you can compare paying yourself a low salary in an S corporation so that you minimize your Social Security and your Medicare tax, and then you're only picking up ordinary income on the dividend. We can plug all that into a calculator, and we can show you where that break even point is and where the tax savings are. And I say it's really your accountant, because they have the tax software. They know everything that you have. They've got your prior years in there, and they can play what if. They can say, well, what if he makes this, raises his salary to this? And it's complicated, especially with the Q bid, the qualified business income deduction, and with all of the phase in and phase outs in the big beautiful bill, and taxes on tips, and I mean, it's complicated. But your accountant should be able to give you an A/B comparison. You're using my plan design, saying, okay, you can do this much contribution. Put it into their software and say, if we did this versus if we did this, what's the difference in the tax? And that part is just pure math.
Right, right. So so again, just to make sure we're being clear, if you did a plan design, doesn't mean they did the plan, but if you did a plan design and you came up with a number that said, let's just say what happens if you contribute $150,000 to a cash balance plan, that
Yeah.
reduces your P&L income, right? Your accountant then can say, here's how that changes the tax
Yes,
situation. Here's how it moves.
exactly.
Got it. Got
Yes,
it.
and
So
I
they
can't
plug it into
possibly
you.
keep up with all those tax rules and how it impacts everything else that you're doing. So maybe there's a couple of like filters or screens in this whole process. I'm willing to talk to anybody who thinks this might benefit them. Answer your questions. We'll both know if you should dig deeper in about 5 minutes. I'm always willing to do a plan design without any cost or obligation for anyone where it makes sense. And then we should take that to your accountant sooner rather than later to make sure that they know what this is, how it works. People tend to be down on what they're not up on. And if your accountant is still stuck, and then you know,
Is that quote of the day, John? You're
yeah,
really catching that when people are down. What the
yeah, that comes from my friend and attorney, Bill White. He's up in Minnesota. And this is a bit of a side story, but Bill invented a really creative way of doing buy-sell agreements for business owners. And it's the best way of doing it. And he was right 20 years ago when he invented this. And I say he's right because there was just a Supreme Court case that came down about 2 years ago that proved Bill White being correct. I can't remember the name of the case now, but it involved valuation of companies that it's a rabbit hole about different ways of structuring a buy-sell agreement. But that's what Bill White used to say. It's like, Chris, you got to talk to their lawyer, you got to talk to their accountant, and because they're going to be down on what they're not up on. And, it's really true.
Yes,
Yeah.
that's true. Aren't
It's
we
easy to
all?
say no. So we involve your tax advisor sooner rather than later, making sure that they agree that this is suitable and makes sense for you. Now, the ones that are up on these plans that I've talked to, they may very well bring something up that say, you know what, I don't think this is suitable for you, especially this year. And when they're knowledgeable, I tend to agree with them. There's a few times I butt heads with the accountants, but if they know what they're talking about, we're going to work together, and I would generally agree with them because there are some things that would you could point out that would make this not the right year to do it. I still think everybody should do it because it's use it or lose it. We should figure out a way to fit it. Now, everybody, but if you're making 300,000-400,000 a year, and you know you're going to owe a lot of taxes either this year or in the coming years, we should have a conversation.
Well, and something else that just, and some people might go, I'm not making 300, 400,000 a year. One of my business coaches once called it um, operator directable cash flow, which just means you're making that before you go buy the tractor, fix the barn, do right. You before you go try to do all of your current uh, tax strategies, right? That's where kind of, what if you could just save that for retirement off the top before you
Well,
went and did all of your other stuff?
there's no question that's correct. But that's also why this is not for everyone. If you're not making that level of income, it's probably not for you right now. But I know you and I are both fans of Dan Sullivan,
Yes.
probably the number one entrepreneur coach in the world. And he makes it, this is so relevant for now. Okay, so you don't see yourself making 500 or $1 million a year. Well, how much are you making? Well, I'm making 100. Wasn't there a time when you were only making 50? Yep. And now you've doubled that. But wasn't there, how much are you making now? 200. Wasn't there a time when you were making 100? Yeah. When you were making 100, did you ever think you were going to get to 200? No, I guess you're right. It's going to happen again, right? If you're doing the things right, if you're listening to Hugh about how to build your agritourism business, if you're doing all these best practices with your people and your ticket prices, you're going to get there. And, just think back to where you were 10 years ago. And
Right.
if you're 10 times where you were then, you'll probably be 10 times where you are now in a few years. But that gets back to setting yourself up. Make sure that you're either paying yourself enough salary or showing enough income on your Schedule C or Schedule F to allow you to make the appropriate size contribution to a.
Right. And then just as we're kind of getting into the end here, you kind of mentioned, right, as you're mentioning your business progression, we kind of talked about different age. Now I'm 51. Um, but is there is there a particular range where um, anybody can do it? Am I new? Am I early? Am I late? Is somebody who's listening to this who's 70 thinking they got a grandson, or somebody who's coming into the business, right? Just give us kind of the age range where the cash balance plan really, let's assume profitability across ages,
Yeah.
but like what kind of age range are you looking at that this is like the prime?
So I've got a colleague of mine that specializes in working with college athletes, and they get these NIT contracts. Is that the right NIL or whatever it is? So they're
NIL, yeah.
making so they're
I did
making
not
three,
get
four,
that in
five.
college for being in the marching
I didn't
band.
get
I
that
did not
either.
get an NIL contract.
So some of these kids have this real high income, and they're great candidates for cash balance because if they're smart, they won't take this money and spend it. They'll put it in their retirement account. So there is no minimum age. That's the proof of that. And if you want me to put a maximum age on it, I would say maybe it's like 75, because when you're 75, you do have to start taking required minimum distributions. So you're putting in 100,000, you have to turn around next year, take 4 or 5,000 out. I mean, it still makes sense for a lot of people. I've done it for people, I think 83 or even 84 is the oldest plan where I've started it. Um, but it's more important is that do you owe a lot of taxes, and do you think you're going to owe a lot of taxes in the next few years? And will you have the cash flow to fund this? Because it's not required that you fund it every year with the same amount, but we want you to see into the future a reasonable expectation that you'll want to put 100,000 a year in for at least 3 to 4 or 5 years at any age.
Gotcha. Gotcha. So really, it is not age discriminatory. It's,
Mm-mm.
hey, are you going to owe taxes, man? Let's see if we can
Yeah.
get Let's see if
I
we can
mean,
get
don't
that
forget,
cleaned up.
the United States of America, you cannot discriminate on the basis of age. And it's a big deal for these plans because anybody can do it. I said something earlier, and I'd like to hit it in this recap here. And this is the first time that I've said or expressed it in this way. So putting money into a cash balance plan today, when you're in a high tax bracket because you're nearing retirement, you've got the snowball of income if you're a farmer, you'll probably be in a lower tax bracket in the future. I think that's pretty safe to say. For the first time in a while, I ask people, almost everybody I speak to, do you think taxes will be higher or lower in the future? Well, hardly anybody said lower for the last 10 years, but I've actually got people that are saying they could see the taxes be lower in the future. So that's one good reason to put money in a cash balance plan now. Taxes might be lower in the future. Anyway, back to my one really nugget of wisdom here. If you're going to need the money in retirement, you'll probably be in a lower tax bracket when you take it out. If
Gotcha.
you're
Right.
never going to be in a lower tax bracket, you're never going to need this money, and it'll grow tax free for a long time, and your grandkids will benefit from it.
Gotcha. Well, that's great. So, Chris, thanks so much. We've taken a bunch of your time. I know you've got another meeting to get to, and we really appreciate it. One of my joys is I call it cross pollination. I feel like we at Maze Quest we stole our maze designer Dave like out of the printing and publishing industry and brought him to create better and more impressive and better thought out maze designs because he wasn't a farmer, right? And I feel like we've kind of pulled out of this wacky financial world into this ridiculous, crazy farming and agritourism and haunted house and Christmas light show kind
Yeah.
of world that maybe you weren't initially used to or even thinking about. But now I feel like I say, you've been at NAFMA twice. We've done a couple of webinars trying to spread the word about this, and now you're kind of embedded, right? You're one of us
And
now.
my
You're a
whole
weird
team,
agritourism person now.
my whole actuary plan design team, they have like 3,000 cash balance plans. They all say they love working with my clients the most.
We're always
I
the
mean,
funnest.
you know, I just think that, farmers and people in the Midwest and the Northeast, they're just good people, and they like, you know, call it without being disparaging. They always haven't had the best tax or financial or legal advice, and now they're getting it, and they're very appreciative.
Yeah, for sure. Well, we appreciate all the time that you took with us getting started with that kind of thing. And I know it's a lot of time to do the NAFTMA convention, and that's a great thing that you're willing to do to share the good word about these cash balance plans. So thanks so
Well, you're
much,
certainly
Chris. Really
welcome, Hugh.
appreciate it.
Thank you. You're certainly welcome.
That's positive business action, and Chris is a positive guy. You're gonna like if you chat with him, you're gonna find out that he's always looking to the future, and he's always trying to figure out how to help me, how to help us out, how to help me out, how to help you out. He fits in with positive business action, and if you say go, he is gonna get it done. And I will say the team has never missed the filings, all of that stuff. They just take that work off of my plate, and I got enough plates. So that part I
You
really
do.
appreciate too. So thanks a bunch
You're
for the team
welcome.
there. And that's positive business action. We'll see you on the next episode. Hope we tried to make tax stuff sexy, baby. We'll see.
Thanks for listening to Positive Business Action. If this episode gave you a useful idea, take a second to follow the show, leave a quick rating, or share it with someone who could use it too. That's what helps this show reach more people who are building something meaningful. You can find links to full episodes, resources, and ways to connect with us in the show notes. Until next time, keep moving forward, keep improving, and keep taking positive business actions.